Now we want to think about a situation where cash is not involved. In other words, we've looked at the idea that cash is the lifeblood of the company, and we can see that when we go into, say, the cash general ledger account. If I go into it, we can see that there's more types of transactions here than in any other type of account. That's because cash is the lifeblood, basically, of the accounting system. Any other account we go into will typically have one or two main forms that make up the detail in the general ledger or transaction report of that account. Let's go back. So if I go back to the first tab and hit the plus button, we know that at the end of the vendor cycle, or at some point within the vendor cycle, money is going to be going out for the purchase of goods and services that we're going to use to help us to generate revenue. On the customer side of things, we expect at some point in time within the cycle, whether it be an accrual or cash cycle, money is going to be coming in for goods and services that we provided to our customers. But we can imagine situations where there is no money involved, possibly situations where we trade or barter. We get paid in something other than cash. Now, obviously, the reason we have cash is because that's going to make it easier. That's made it so we don't have to barter. Cash is going to be an easier mechanism to use for exchange. However, we can still have situations where we have a barter situation. Even though we're bartering, it doesn't mean, as you might expect someone to try to do in the United States, that you can avoid basically taxes, would be the idea, right? Because you might say, hey, if I didn't actually get paid in cash, then if I'm on a cash basis for taxes, for income taxes, and no cash is involved, then it's not actually revenue. But obviously the IRS is not going to see it that way. They're going to say, hey, look, although a lot of the tax code might be on a cash-based system, we're going to apply revenue recognition concepts for an accrual basis in the instances where we think it's applicable. In other words, if you get paid by something other than cash, you still have to recognize revenue generally. And for an income tax purposes, you'd still have to pay the revenue, right? So we should be recording it in the system. It gets a little bit tricky to think about how am I going to record it in a system. If I, for example, do landscaping services and I have a client that is a restaurant and we've decided they're going to give me free meals and I'm going to give them landscaping services, well, I can't really wait till something clears the bank and then record, say, the cash that clears the bank that I receive as revenue or the cash that I pay as an expense, because there's not going to be anything on the bank. We have exchanged something we're imagining as of equal value, and it kind of nets out against each other. But we still need to record the revenue and the expense into the system. And also, just note that it's also important if you're in a barter type of situation, in any kind of situation, it's useful to try to track, the benefit that you're providing someone else versus the benefit that you're receiving. I'm actually not always great at doing that, but I think it's actually a better thing to be able to do, because if you don't do that, then you're either going to provide more of the work and you're going to be feeling like over time you're being taken advantage of, which is most likely going to blow up at some time, or the other person's going to feel that way, that they're providing more than you are and you guys aren't tracking it together. And so they might not tell you, and then they're going to blow up at some point in time and say, hey, look, I'm doing more for you than you're doing for me. So it's actually, I think it's the transparency of tracking these kind of, even the barter situation, even if it's like, it's like seems like a minor thing up front, could over time become something that builds up if you don't kind of track, if you have an even type of transaction between the two of you. So I would suggest doing that. So how would we do that then if it's a barter? Let's just think about this in terms of our flowchart first. So here's our flowchart, and we're going to say, all right, if the money, for usually when the things that we purchase, if we're purchasing goods and services, we'll say, let's say it's not a meal, but we're getting supplies or something like that in exchange for the landscaping services, so that the thing that we're getting isn't for personal use. We're going to say it's part of the business, right? So we're paying for something that's an expense in the business, and then we're receiving something. So we're going to say, okay, well, on the money going out, normally what would happen is if I was to buy the supplies, I would be writing a check for the supplies, for example, at which point it would clear the bank And when it clears the bank, I would record it as something like supplies expense or something like that. And if it was something that I purchased personally, then you can imagine, then it wouldn't be an expense. You could do the same type of thing. What would it be? It would be a draw. You'd have to record it, in essence, as money that came out of the checking account that was basically a draw, go into the equity section rather than an expense. Or you can imagine that we enter a bill into the system, which increases accounts payable, and then we pay off the bill. That's if cash was involved. If cash was involved on the customer side of things, what would happen? Well, if they pay us and we wait till it clears the bank and it was a deposit, then once the deposit comes through, I could just record that deposit form as revenue. Or we can imagine a situation where we invoice the client and we're going to get a payment on it at some future point in time. So if we have a barter situation, we can kind of do the same thing as if cash is involved, but instead of using the actual checking account, maybe we set up a clearing account for that transaction. So the two ways that we might do it is if I bartered something at the same point in time, and say I got supplies and I provided landscaping services at the same point in time, then we might enter the transaction, which would be similar to maybe a sales receipt form at that point in time, which would record the revenue and deposit it not into the checking account, but we'll put it into a clearing account. And then we can record on the other side, and that would record the revenue. And then on the other side, we can have an expense form or check form, which would record the expense and record the other side into our clearing account. And the clearing account would then tie out. It would map out and it would go back down to zero. Or we can imagine a situation, maybe it's not even, like we're providing more value or they're providing more value, and we want to track the tab of the value that each of us is providing to see where we stand. In that case, we might do the accrual thing. We might enter an invoice, which would increase the accounts receivable, and it would increase the revenue. And then we'd enter a bill on the other side of things. And then when we got the barter transaction, when we got paid, we'd have to record the received payment, which once again, we can record not to the checking account, but rather to the clearing type of account. And when we make the payment, similarly with a pay bill situation.